You're listening to the Financial Source podcast on YouTube.
Welcome to the Financial Source podcast. It is Monday, February 2nd, 2026. And if you looked at the markets this morning and felt a little bit of motion sickness, you are definitely not the only one.
No, not at all.
We are looking at a landscape just defined by a massive surge in volatility, a really violent unwind in the commodities sector, and some very expensive jitters in big tech.
It feels like markets are caught between a historic sell-off in precious metals, triggered by that Federal Reserve Chair news, and, well, these deep doubts about the AI infrastructure boom.
And on top of all that, you have this geopolitical map being redrawn in real time. That war premium is just vanishing from energy prices.
Right, with this potential pivot from escalation to, well, maybe negotiation in the Middle East.
So today you're going to get the full picture. The Nvidia OpenAI drama, that crash in gold and silver, and the critical central bank decisions looming this week. Let's unpack it.
It really is one of those days where the screen is just a sea of red, but the stories behind that red are what really matter.
Well,
It feels like we're seeing a collision of reality checks across different asset classes all at once.
yeah, that's a good way to put it. I want to start with the sector that has basically been the engine for the entire stock market for, the last few years? Technology.
Right.
Specifically the artificial intelligence trade. The market darlings are suddenly looking a little less loved this morning. The NASDAQ is under pressure, and it seems like the anxiety is centered squarely on infrastructure. What actually kicked this off?
It started with a report from the Wall Street Journal about Nvidia. See, for a long time, the narrative the story investors have been buying into is that Nvidia isn't just selling the chips. They're actively funding the ecosystem that then buys those chips. It's a self-reinforcing cycle.
Right, the idea that they're priming the pump to keep their own demand high.
Exactly. But over the weekend, there was this substantial reporting about a plan for Nvidia to invest $100 billion United States dollars into OpenAI.
Okay, I have to pause you there.
Yeah.
100 billion.
Yeah.
That is not a normal investment number. That's the GDP of a mid-sized country. It's a staggering amount of cash for one corporate deal.
It's astronomical. I mean, to give you some context, that's roughly what the entire United States Department of Education spent in a year back in 2024. It's nation-state level capital.
And the report says this deal is, dead?
Stalled, maybe dead. Discussions have apparently broken down due to internal concerns. But what really rattled the market wasn't just the report itself. It was the damage control that followed.
Okay.
NVIDIA's chief executive officer, Jensen Huang, came out to address it.
I saw the headlines on that. He tried to calm everyone down, right?
Yeah.
Said they're still partners.
He did. He said they will definitely invest in OpenAI. He even said it'll probably be their biggest investment ever. But, and this is the pivot point that traders really latched onto, when he was explicitly asked about that specific $100 billion figure, he said, and I'm quoting here, no, nothing like that.
Nothing like that.
Wow.
That feels like a massive walk back.
It's a huge walk back, and the market hates ambiguity. Trading desks looked at that denial and said, okay, so the blank check isn't actually blank. It just signals the whole deal structure is shaky.
And I guess if Nvidia, the undisputed king of this hill, is hesitating on the price tag, what does that say about the return on investment for everyone else?
It signals that maybe the economics of AI aren't as infinite as we thought. And look, it's not just Nvidia, is it? We saw something from Oracle this week, too, that plays right into this same fear.
We did. Oracle announced they're planning to raise 50 billion United States dollars. And just so we're clear for everyone listening, when we say raising, they're borrowing, right? They're going into debt.
Correct. They're issuing bonds to get cash now. And they need that $50 billion specifically to fund cloud infrastructure.
Okay, so let's connect these dots. You have Nvidia seemingly backing away from a $100 billion commitment. You have Oracle rushing to borrow $50 billion. What's the theme here?
The theme is capital intensity. That's the buzzword you are going to hear everywhere this week.
Capital intensity. Okay, break that down. What does that actually mean for the market?
In simple terms, it means that to make $1 of profit in AI, you have to spend an unprecedented amount of dollars on hardware, on electricity, on cooling first. It is just expensive to be in this game.
So investors are looking at these numbers, 50 billion here, 100 billion there, And they're just getting sticker shock.
Total sticker shock. They're starting to ask, is the return on investment actually going to justify burning through this much cash this quickly?
It feels like the market is suddenly asking for the receipts after years of just buying the dream.
Exactly. The dream phase is ending and the audit phase is beginning.
And when you enter the audit phase, volatility usually follows. Speaking of volatility, if tech is feeling shaky, the action in commodities was, well, it was basically a horror movie. You used the phrase violent unwind earlier.
It's really the only way to describe it. This was the defining cross-asset shock of the week, for sure.
Let's run through the numbers because they are just eye-watering. Spot gold is down over 4% today, but looking at the charts from the overnight session, at one point it was down nearly 10%.
A 10% drop in gold in a single session. That is historically rare.
Right.
Remember, gold is supposed to be the boring, stable rock in your portfolio. It isn't supposed to move like a cryptocurrency or, a meme stock.
And silver.
Oh, silver took an even bigger hit. It fell 16% to a trough near $71.40 an ounce. It's bounced back a bit to around 80, but that is a massive liquidation event.
16% in a few hours. If you were holding leverage on silver, you were just wiped out.
Oh, absolutely. That triggers margin calls everywhere. A margin call is when your broker calls you and says, you don't have enough cash to cover your losses, so we are selling everything you own right now.
And that forces more selling, which drives the price down further. It's a cascade.
The cascade, exactly.
So what pulled the rug out? Usually, when the world feels this chaotic, and we'll get to the geopolitics in a minute, people run to gold, not away from it.
The catalyst here was a name, Kevin Warsh. The confirmation of Kevin Warsh as the new chair of the Federal Reserve.
Interesting. Okay, so Warsh is the new Fed chair. Why does his name specifically cause gold to crash?
Because Kevin Warsh is viewed as a hard money advocate. Historically, he's been really critical of the Federal Reserve printing too much money or keeping rates too low for too long.
And gold loves it when the Fed prints money, right?
Right.
Because it devalues the dollar.
Precisely. Gold is a hedge against a weak dollar and loose monetary policy. So if the market thinks Warsh is going to be strict, turn off the money printer and keep the dollar strong. Well, the investment case for gold gets much weaker.
So is this a massive sell the news event?
On a truly massive scale. Specifically, during the Asia-Pacific session, we saw Chinese participants just aggressively locking in profits. They saw the Warsh news, realized the easy money era might be pausing, and they just hit the sell button. They sent gold tumbling down to nearly 4,400 United States dollars an ounce before it found a floor.
And when you have a sell-off that big, it usually drags everything else down with it, right?
Sure.
Because traders have to sell their good assets to pay for their losses.
Exactly. That's the contagion effect. Copper got hit too. It gapped below 13,000 United States dollars per metric ton.
And copper is usually called Dr. Copper because it diagnoses the health of the global economy. If copper is dropping, does that mean the economy is sick?
It suggests the patient is looking a little pale.
Yeah.
It's reflecting a fear that global demand is sputtering, particularly from that Chinese manufacturing engine. We saw some weak economic data out of China, which compounded the sell-off. We can get to that.
Okay, so we have tech jittery about costs. We have metals crashing because of the new Federal Reserve chair. Now let's look at energy. Usually when we see headlines about the Middle East, oil spikes because we're afraid of war. But we are seeing the opposite. Crude is slumping.
Right. West Texas Intermediate is near 61.44. Brent is near 65.45. These are lows we haven't seen in a while.
So why is energy acting so differently?
Because the geopolitical map is being redrawn, or at least the market thinks it is, that war premium is fading fast.
Break down war premium for us quickly.
Sure. When there's a risk of war, traders add a few extra dollars to the price of every barrel of oil just in case supply gets cut off. It's like insurance. Through late January, prices were built on the fear of an immediate military escalation in the Middle East.
But that changed over the weekend.
It did. The headlines shifted significantly. There are reports that talks between the United States and Iran could happen in Turkey as early as this week.
And we had comments from President Donald Trump on this as well, I think.
Yes. President Trump told reporters that Iran was seriously talking. And then you have that report from Axios confirming a meeting in Turkey. When the algorithms and the traders see Turkey and meetings, they immediately start pricing out the risk of a regional war.
They just strip that insurance premium right out of the price.
Instantly. It's amazing how quickly that sentiment can turn. One week, it's imminent conflict. The next, it's diplomatic summits.
Yeah?
And we're seeing that unwind in natural gas, too. Dutch prices drop below 35 euros. That's partly the geopolitical tension easing, but also that Arctic storm premium unwinding. The fear of freezing weather is passing. Supply looks stable, so the price drops.
So, to recap the chaos so far, tech is nervous about money, metals are crashing because of the Fed, and oil is dropping because peace might be breaking out. Speaking of politics and peace talks, let's zoom out to the broader geopolitical landscape. We have a huge election happening in Japan this Sunday.
The snap election on February 8th. This is absolutely critical for Asian markets.
Why should a listener in the US or Europe care about a Japanese election?
Because Japan is the world's biggest creditor. They lend money to everyone, so if their politics shift, their money moves, and that shakes the whole world. The polling suggests we aren't just looking at a win for the Liberal Democratic Party, the LDP, but a landslide. They could win over 300 seats, well above the 233 needed for a majority.
A landslide usually means stability, but I saw some wild moves in the Japanese yen this week.
That was down to Prime Minister Sanae Takaichi. She's known for being a bit outspoken. She made comments that seemed to praise a weak Japanese yen, said it helps exporters and boost returns for the government's foreign exchange fund.
Which usually sounds like a green light for currency devaluation, like she wants the yen to be cheap.
Exactly, and traders jumped on that immediately. The yen gapped higher, meaning the dollar got stronger against it. But then she had to clarify.
Well,
She came back and said she wasn't advocating for devaluation, just noting the mechanics.
the old I was just observing defense.
Right. The market pared back the move, but it just shows how sensitive traders are to her rhetoric right now. Everyone is on a hair trigger when it comes to the yen.
Okay, let's shift to the Russia-Ukraine situation. We have trilateral talks coming up.
Yes, set for Abu Dhabi on February 4th and 5th. This involves the United States, Russia, and Ukraine.
That's just a couple of days away. Is there any reason to be optimistic? We've heard about talks before that went nowhere.
There are some actual signals this time. The Kremlin has said differences have narrowed on some issues. Now, obviously not the complex ones, but some. And Ukrainian President Volodymyr Zelensky confirmed that Ukraine is ready for substantive discussions. Plus, we had United States envoy Steve Witkoff meeting the Russian envoy down in Florida.
So it seems like there's a concerted diplomatic push happening in the background. But while those talks are happening, trade tensions are heating up elsewhere. President Trump had some strong words for Canada.
He did. He warned that if Canada makes a trade deal with China, there will be a substantial response.
That is a pretty direct threat to a neighbor.
It is. His argument is that the United States doesn't want China to take over Canada via a backdoor trade agreement. He views Canada as a potential Trojan horse for Chinese goods to enter the U.S. market tariff-free.
And meanwhile, China and the European Union are still haggling over dairy.
Dairy. It sounds small, but it's symbolic. China proposed final anti-subsidy duties on European Union dairy. The rate is up to 11.7%.
That sounds high, but wasn't it supposed to be even higher?
Much higher. They were threatening 42.7% earlier. So dropping it to 11.7 is actually a de-escalation. It's a tariff, sure, but it's a let's still do business tariff, not a go-away tariff.
Got it. Okay, let's bring it back to the economic gears turning behind the scenes. We have a massive week for central banks, and Australia seems to be the real odd one out here.
The Reserve Bank of Australia is the main event on Tuesday, and the market pricing here has shifted violently. Markets are now pricing in a 76% chance of a 25 basis point hike.
A hike. In 2026, while everyone else, the Federal Reserve, the European Central Bank, is talking about cuts or holding steady, why is Australia going the other direction?
Because their data is just undeniable. They have really strong jobs numbers, meaning people are earning money and spending it. And they have sticky inflation. Prices are not coming down. The Reserve Bank of Australia might be forced to move while the rest of the world waits.
And just for anyone new to the lingo, a basis point is just 1/100th of a percent, so 25 basis points is 1/4%.
Exactly. It doesn't sound like much, but in the world of global finance, 1/4% hike when everyone else is cutting is a massive divergence.
Speaking of cuts, what's the mood at the Federal Reserve in the U.S.? We know Warsh is coming in, but what about the current governors?
Governor Michelle Bowman is out there supporting a rate pause. She says inflation is still elevated, but, and this is interesting, she's projecting cuts in 2026. So she's saying, wait now, cut later.
And President Trump, he always has an opinion.
He certainly does. He wrote an opinion piece in the Wall Street Journal. He said he hopes Kevin Warsh will lower interest rates, but he also acknowledged that Warsh won't do it just because of White House pressure.
It's a bit of a wink, wink, nudge, nudge dynamic. I won't make you do it, but I really hope you do.
Exactly. He's just setting the stage publicly.
Briefly, on the fiscal side in the U.S., are we shutting down the government again or not?
It looks like the partial shutdown is ending. The Senate passed a $1.2 trillion funding deal, and the House vote is imminent. Speaker Mike Johnson says it should be over by Tuesday.
Good news for government workers, at least. I want to touch on one last macro theme before we wrap up, and I think this is the most fascinating long-term story. The divergence between India and China.
Yeah.
We saw some very different data points this week.
This is a story of two giants going in opposite directions. In China, the official Purchasing Managers' Indices, the PMIs, unexpectedly slipped into contraction.
Just to define that for everyone, PMI is a survey of factory managers, right? A temperature check.
Correct. If the number is above 50, the economy is growing. If it's below 50, it's shrinking. And China's number fell below 50. The manufacturing engine is sputtering. And on top of that, Beijing raised the value-added tax on telecom services to 9%.
So weak growth and higher taxes. That's a tough combination for any economy.
It is. Now, compare that to India. The sentiment there is completely different. Their budget raises capital spending by 9% for the upcoming fiscal year.
Wow.
They're being aggressive. They're proposing tax holidays for foreign cloud companies and boosting manufacturing in semiconductors.
Tax holidays for cloud companies. That sounds like a direct play for that AI infrastructure we were talking about at the start of the show.
It is a direct pitch to global capital. They are saying, come build your data centers here. We won't tax you.
And can they afford to do that?
Well, they claim they can. They're balancing it with fiscal prudence. They're aiming to reduce their debt-to-GDP ratio to 50% by 2030. So they're spending on growth, but promising discipline on debt. It's a very attractive narrative for foreign investors right now.
Especially compared to the uncertainty in China.
Absolutely.
So let's try to synthesize all of this. It feels like a week of major adjustments, a real reality check.
It really is. Think about the three main buckets we discussed. First, energy. You've got a peace discount hitting oil as the geopolitical temperature lowers.
Right.
Second, metals. You have a liquidity shock hitting gold and silver because of the Warsh announcement and all that profit taking.
And third, technology. A reality check hitting AI spending.
Exactly. That limitless spending narrative is hitting the wall of capital intensity concerns.
So for you listening, trying to navigate this week, what should you be watching?
Tuesday is the pivot point. Watch the Reserve Bank of Australia decision. If they hike, it confirms inflation is still a global fight. And watch the headlines from Turkey regarding the United States-Iran talks. Those are the two things that could either stabilize this market or accelerate the volatility.
And here's a thought to leave you with. We have precious metals crashing, meaning cash is being raised. We have tech stumbling because people are worried about the cost of doing business in the U.S. Capital has to go somewhere.
That's the golden rule. Money never sleeps, it just moves.
Exactly. So if India is offering tax holidays for data centers and increasing CapEx, while the U.S. struggles with these capital intensity questions and China is contracting, are we seeing the beginning of a geographic rotation in the AI trade? Is the next leg of the AI boom going to be built in Bangalore instead of the Bay Area?
It's a very real possibility. If the incentives shift, the infrastructure will follow.
Something to think about as you watch the tickers this week. Thanks for listening to the Financial Source Podcast.
Appreciate you tuning in. Join us again on the Financial Source Podcast.
That's it for today. Thanks for being here. We'll catch you in the next one.